So good evening all of you. So our topic is IAS 21. So the effects of changes in foreign exchange rates. So the effects of changes in the foreign exchange rates. So for example, if entity operates in more than one country, then entities operations are there in more than one country, then how to translate one currency into the another currency, and how to represent that foreign currency transactions or foreign operations in the financial statements of the entity, and how to treat that gain or loss arised due to the changes in the exchange rates. So into when while exchanging the expected foreign currency into the presentation currency. So these are the main objective of this standard. So the main objective of this standard is the main objective of this standard is how to include foreign currency transactions, and foreign operations foreign operations in the financial statements of the entity. In the financial statements of the entity, and how to translate that foreign currency transactions into reporting or presentation currency. Reporting or presentation currency. So, and the last one is how to account for gain or loss in gain or loss created gain or loss due to translation of currency. So due to translation of a currency. So if any foreign currency transactions incurred, or if any foreign operations transactions relating to the foreign operations of the entity, then how to present them in the financial statements, and how to translate the foreign currency transactions into the presentation currency or reporting currency, and if any gain or loss created due to the, so while exchanging the one currency into the another currency, then that gain or loss, how to account for that gain or loss. So these what we are going to discuss in this standard. And before that, we have to know so some definitions which are useful while reading this standard. The first one is what? Exchange rates. Exchange rate simply said at which the rate at which one currency is converted into another currency. So the rate at which one currency is converted into another currency is said to be a what? So exchange rate. For example, $1 is equal to 75 rupees. So this is what exchange rate. For converting the dollar into the rupee, how many rupees we need to pay? So 75 rupees. So that is what exchange rate. And another one is presentation currency. So presentation currency means the currency in which financial statements are presented. Financial statements are presented is said to be about presentation currency. So the currency in which the financial statements are presented, and this is also called as what? Reporting currency. This is also called as what? Reporting currency. And another one is foreign operations. So foreign operation. So what is meant by foreign operations? Foreign operations are nothing but any subsidiary or associate or joint venture, any subsidiary or associate or joint venture or a branch whose activities are based in a country other than that of a reporting entity. Other than that of reporting entity. So, for example, here head office is located in India, and its branches are distributed are available in different areas. So, where we have the branch one in US and branch two in UK and branch three in Australia. So, these all are branches are said to be what? These all branches are said to be what? Foreign operations to the reporting entity. Here, reporting entity is nothing but what? India. Reporting entity is nothing but what? Head office located in India. Okay. So the foreign operations are nothing but the subsidiary or associate or joint venture or branch whose activities are based in a country other than that of a reporting country. Other than that of a reporting country. It's said to be about foreign operations. Foreign operations. And another one is so functional currency. So, what is meant by functional currency? Functional currency is nothing but the currency, the currency of the primary economic, primary economic environment in which in which that entity operates. So the currency of the primary economic environment, the currency of the primary economic environment in which that entity operates. For example, XYZ Limited is there. It is located in India. So and it has the customers throughout India, and it export the goods to outside India, etc. So here XYZ Limited is as its main operations in India. So its a functional currency is nothing but what? Indian rupee, INR. Its functional currency nothing but what? INR, Indian rupee. But while determining the currency is a functional currency, we have to consider some factors. We have to consider some factors. So before determining the functional currency, the following factors are required to be considered. The following factors are required to be considered. So there are two factors are there. So that is nothing but what? Primary factor, and another one is what? Secondary factors. So primary factor and a secondary factor. So what are the primary factors? So the primary factors are nothing but so first the currency. So the first one is the currency that mainly influence the selling price of the goods and services. The currency that mainly influence the selling prices of the goods or services. So, and the second one is the currency. So, the currency of the country competitive forces, whose competitive forces and regulations mainly determine the selling price of the goods and the services. Okay. And the third one is the currency that mainly influence the labor, materials, and other cost of providing goods and services. So here, so three factors are there. So these three factors are treated as primary factors. So which are considered before determining the currency as a functional currency. So the first one is the currency that mainly influence the selling price of goods or services, and the currency of the country whose competitive forces and regulations mainly determine the selling price of goods or services. So generally, the reporting country where it operates mainly, that currency generally considered. For example, here XYZ Limited is there. It operates in India. So generally, it purchase the goods in India and it produce the goods in India and it sell the goods in India. Then what is the functional currency of this country? Is nothing but what? Indian rupee, nothing but what? INR. So here the main currency that mainly influence selling price of goods or services is nothing but what? Rupee. And what are the competitive forces? Nothing but which are available in India will fix the and which are useful in determining the selling prices. For example, if XYZ Limited is a Indian company and it import the goods from outside India, and then by using that imported goods, it produce the products in India and it traded in India or to the outside India, So here that party may purchase the goods from the outside India or from the another country, etc. So, but we have to consider which forces are available while determining the prices, and that forces are available in which country. That country currency is treated as a functional currency. Here, XYZ is located in India. It considers the competitive forces which are available in India while determining the prices. It considers those competitive forces. And another one is here, what is meant by influence the selling price of the good? Influence the selling price of the goods means where the sales are the currency in which that sales are denominated and currency in which that sales are settled, currency in which that sales are denominated and the sales are settled. In the same way, currency in which the labor cost and material cost and other cost incurred in relation to the goods or services so are denominated and those are settled, that currency is treated as a what? Foreign functional currency. That is treated as a what? Functional currency. And along with that, some secondary factors are also considered while determining the currency as a functional currency. Some secondary factors are also considered. So that is nothing but the currency in which the funds from financing activities are generated. Currency in which the funds from financial activities are generated, and currency in which receipts from operating activities are retained. Receipts from operating activities or retail. So along with the primary activities, we also require to consider another activities called as secondary activity. So these are all said to be about extended factors required to be considered before considering that currency as a functional currency. Before considering that currency as a functional currency. And another thing is, if primary factors are not useful to decide, primary factors are not useful to decide the respective currency as a functional currency, then we use which factor? Second factor. Then we use which factor? Secondary factors. For example, in some gaming companies are there. So where the sales are generated from the different countries. So for example, so some sales are generated from the USA, some sales are generated from the UK, some sales are generated from India, some sales are generated from another country. So here sales are denominated in different currencies. Sales are denominated in different currencies. Then how can we consider which currency is treated as a functional currency in that case? So in that case, primary factors are not available. And even for example, currency that mainly influence the labor, material, other cost of providing the goods and services. So here, so wherever labor is available and wherever the expected equipment is available, wherever is possible, we establish the office, and where in that case we provide the services. In that case we provide the services. So in that case, in such a case of a gaming industry, the primary factors are not considered. The primary factors are considered because the sales are generated from the different countries, and expenses are also denominated in different currencies. Then how can we determine the respected currency as a functional currency? In that case we use what? Secondary factors. So the secondary factor, coming to the secondary factors, it is relating to what? So how the finance is generated, from where the finance is generated, and where that operating income is generated and retained. So the currency in which funds from the financing activities are generated, the currency in which funds from the financing activities are generated, and the currency in which receipts from the operating activities are retained. Receipts from the operating activities are retained. That currency is said to be a what? Functional currency. So the currency in which funds from financing activity means from where the respected finance is generated, and the currency in which the receipts from the operating activities are retained. These two factors are considered for determining the currency as a functional currency. But remember, these two factors are considered if the primary factors are not useful for concluding the currency as a functional currency. In that case only we use what? Secondary factors. In that case only we use what? Secondary factors. Okay, so this is what is meant by functional currency. So functional currency is nothing but what? So functional currency is nothing but currency of the primary economic environment in which that entity operate is said to be a what? Functional currency. Is said to be about functional currency. For example, if the company operates mainly in India, then rupee is said to be a functional currency. If the company operates mainly in USA, then US dollar is said to be a functional currency. Then For determining the currency as a functional currency, we have to consider two factors, that is nothing but what primary factors and secondary factors. But the secondary factors are considered if the primary factors are not useful for concluding the currency as a functional currency. Okay. Then, so these are the definitions relating to the some items. Then, first of all, what are the first what are the steps for translating foreign currency amounts into the functional currency? So first we have to identify the functional currency. Identify what is the functional currency of the reporting entity. Reporting entity. Then second one, the entity. Second one, the entity translate all foreign currency transactions or items into its functional currency. Functional currency. But here, the remember, so for translating the foreign currencies into functional currency, we use what? Exchange rate. We use what? Exchange rate. Then, which rate is used? For example, Mr. X sell the goods to Mr. Y, so around 10 lakh dollar, worth of the goods sold by the party on credit basis. So here Mr. X is located in India and Mr. Y is located in USA. Mr. Y is located in USA. Here the goods sold by the party worth around 10 lakh dollar. 10 lakh dollar. So here the goods are sold. The goods are sold on 11/2000 X1, 11/2000 X1, and that party so settled the amount on 1/5/2000 X1. For example, 1/3/2000 X1. 1/3/2000 X1. Then which rate is considered? Which rate is considered? So whether the rate available on the date of transaction is considered every time, or the rate available on the date of settlement is considered. The rate available on the date of settlement is considered. So that is the question. So generally there are three types of exchange rates are there. Three types. One is what? Spot rate. Another one is what? Closing rate. And another one is what? Average rate. So spot rate is nothing but what? Historical rate. The rate available on the date of transaction is said to be what? Spot rate. The rate available on the date of transaction is said to be what? Spot rate. And the closing rate is nothing but the rate available on the date of closing the financial state or date of preparing the financial statement is said to be what? Closing rate. The rate available on the date of preparation of the financial statement is called as what? Closing rate. Then average rate simply is nothing but what is the opening rate and what is the closing rate by 2. Opening plus closing rate by 2 is said to be average rate. In some cases we consider spot rate, in some cases we consider what? Closing rate, in some cases we consider what? Average rate. So which rate is used while translating the foreign currency into the functional currency? That is the important thing. And the third one is And the third one is entity reports the effect of entity reports the effects of such translations such translations of foreign currency into functional currency. So that is nothing but simply some gain or loss is arised while translating the foreign currency into functional currency. Some gain or loss is arised. So because one rate is there on the date of incurring the transaction, another rate is there on the date of settlement. On the date of settlement, then automatically due to the differences in exchange rate, some gain or loss is created. Then the question is how to account for that gain or loss. How to account for that gain or loss. So these are the general steps. First, we have to identify what is the functional currency of the reporting entity. The entity, then second one is the entity translate all foreign currency items into the functional currency, and the entity reports the effects of such transactions of foreign currency into the functional currency. Nothing but how to account for that gain or loss created due to the changes in exchange rates while translating the foreign currency into the reporting currency, or sorry, a functional currency. Okay, then so then coming to the accounting. So first, so the foreign currency transactions, that is called as initial recognition. And how to record, those are called as recognition, either initial recognition and subsequent recognition. Coming to the initial recognition, the foreign currency transactions are initially recorded at the rate available on the date of transaction or average rate. So that foreign currency transactions should be recorded initially at the rate available on the date of a transaction. At the rate available on the date of a transaction. If the actual rate on the date of transaction is not available, then which rate is of average rate is considered. Then we consider what average rate. Then coming to the subsequent recognition. So coming to the subsequent recognition, how to recognize in the subsequent period. So how to recognize in the subsequent period. So in that case, so for this purpose, the total assets and liabilities are classified into the two types. One is monetary items and another one is non-monetary items. Monetary items and another one is non-monetary item. So monetary items are nothing but those items which are easy converted into the cash. Example, debtors, creditors, borrowings, etc. And other than monetary items are covered under non-monetary. Example, tangible, fixed assets and intangible assets inventory, etc. So these are all covered under what? Non-monetary item. So initially everything, whether monetary item or non-monetary item, those are recorded at what rate? Actual rate. Actual rate is nothing but the rate available on the date of transaction we have recorded. But coming to the in the subsequent period, whether exchange difference means due to the change in exchange rates, any profit or loss created, whether that gain or loss is recognized in the books of accounts or not, depends upon what? Monetary item and non-monetary item. Monetary items and non-monetary item. In case of the monetary item, in case of the monetary item, any loss, so any gain or loss created due to change in exchange rates, any loss or gain created due to change in exchange rates is transferred. Statement of profit and loss is transferred to statement of profit and loss. Then, for example, Mr. X, Mr. X sell the goods. Mr. Y, Mr. Y, Mr. X sell the goods to Mr. Y. The total goods sold to the party. For example, he is located in USA. He is located in India. Then here the total worth of the goods are around 10 lakhs on 1 1 2000 x1 1 1 2000 x1. Then on the date on 1 1 2000 x1, what is the entry to be recorded? So debit Mr. Y account, credit sales account. So how much? So on this day, $1 is equal to, so on this day $1 is equal to, for example, 70 rupee. On this day $1 is equal to 70 rupee. So, for example, he is located in India. He is located in US. He is located in USA. Then how to record? So how to consider? So $1 is equal to 70 rupees. So around 10 lakh worth of the goods sold by the party to the Mr. Y. So then we record what? 10 lakh into 70. How much? 70 lakh. 700 lakhs. 700 lakh we recorded. 700 lakh we recorded. So for example, on 13 2000 x1, 13 2000 x1, Mr. Y pay the amount. Mr. Y pay the amount. On that day, $1 is equal to 75 rupee. On that day, $1 is equal to 75 rupee. So here, that party pay the how much amount? 10 lakh dollar. That party pay the 10 lakh dollar to us. But then we convert that dollar into the rupee. Then how much amount we get? Around 75 lakh. Then we write the entry debit bank account. So 750 lakh and credit Mr. Y account 750 lakh. Credit Mr. Y account 750 lakh. So here, how much difference amount is created? So 50 lakh. 50 lakh is a profit to us, right? 50 lakh is a profit to us, and that amount is a transfer to the statement of profit and loss. Then we transfer that amount debit Mr. Y account 50 lakh, credit statement of profit and loss account 50 lakh. Statement of profit and loss account 50 lakh. So here, so means in case of any change in exchange rates, in between date of transaction and date of settlement. Date of transaction and date of settlement. In that case, the difference created or the gain or loss created due to the changes in exchange rate is transferred to what? Statement of profit and loss. Statement of profit and loss. And second example. So this is the example. So for example, coming to the example 2. So coming to the example 2. So for example, Mr. X sell the goods to Mr. Y around for 10 lakh dollar on 1/1/2000 X1. $1 is equal to 70 rupee, and on 31st March 2000 X1, $1 is equal to 78 rupee. On 1/5/2000 X1, $1 is equal to 75 rupees. And that means here, in between date of transaction and the date of settlement, date of closing the books of account, date of financial statement is there. In that case, auto record. Okay. So in that case, first on the date of a transaction on 1/1/2000 X1, he write journal entry debit Mr. Y account, credit sales account. How much amount? 700 lakhs. Then on 31st March 2000 X1, we have to record the transaction at the rate available on the date of financial statement, nothing but what? Closing rate. So the monetary transactions, if any, unsettled. So remember, if a monetary transactions, if any, unsettled on the date of balance sheet, we have to record at the closing rate. We have to record, re-record at the closing rate. Then due to that, any gain loss created is also transferred to what? Statement of profit and loss. Statement of profit and loss. Then how much amount is there? 700 lakh. But in this case, on 31st March 2000 X1, the exchange rate increases. The exchange rate increases. So $1 is equal to what? 78. $1 is equal to what? 78. Then what is the amount? So we have the profit, right? We have the profit. In case of profit, P&L statement is P&L account is credited. So debit Mr. Y account. How much excess amount is there? 8 rupee. 8 rupee per dollar. 8 into 10. 8 lakh. 8 into, sorry, 80 lakh. 80 lakh. So credit statement of profit and loss account. Statement of profit and loss account. Then next, on the settlement date. On the settlement date. On the settlement date, if you observe, so we have to compare what? On the rate available on the settlement date is compared with rate available on the date of financial statement. What is the rate available on the date of financial statement? 78. Rate available on the settlement date is 75. Means the foreign exchange rate is decreased. How much decreased? 3 rupee. So then, so we received what? Bank. So bank account debited. Sorry, debit bank account. How much amount we received? 750 lakh. Credit Mr. Y account 750 lakh. Credit Mr. Y account 750 lakh. Then that difference excess amount is there, that is transferred to P&L. So debit statement of profit and loss account. How much difference is there? 3. So 3 into 10, 30 lakh. Credit Mr. Y account, how much? 30 lakh. How much? 30. Is it clear? So monetary transactions should be recorded at the rate available on the date of settlement. At the rate available on the date of settlement while settling the monetary transaction. But due to the change in exchange rate, any gain or loss created to the entity will be transferred to statement of profit and loss, whether it is a gain or loss. Beta, in case of unsettled monetary items are available on the date of a balance sheet or on the date of a financial statement, then those are re-recorded at the closing rate. Those are re-recorded or retranslated at the closing rate. Then any gain or loss created due to the retranslation, that is also transferred to what? Statement of profit and loss. Statement of profit and loss. These are the two examples. I hope you guys understood. Okay, so this is about what monetary transactions. Okay, so monetary transactions are nothing but what? The items which are easily converted into cash, nothing but debt or credit or and borrowings are covered. And coming to the items other than monetary items like profit and plant and machinery account, intangible assets and inventory are covered under what? Non-monetary item. Are covered under what? Non-monetary item. And remember, so retranslation of non-monetary item is not required. Retranslation of non-monetary item is not required. So why? Because those are not required to settle. Because these are all nothing but what investment. These are all nothing but what investment. Those are not required to settle. So that's why. So retranslation of non-monetary item is not required. So there is no question of gain or loss. There is no question of gain or loss. But there is one interesting topic relating to the non-monetary item. I will explain here. In case of non-monetary item, so best example is plant and machinery. That is nothing but what? Property, plant and equipment. So generally these are accounted as per IAS 16, non-current asset, tangible non-current asset. So while in case of IAS 16, two models are there. Either as per cost model for recording the PPE or fair value method. Fair value stands for what? Revaluation. Revaluation model is there. In case of cost model, this PP is always recorded at the cost, either initially or subsequently. But in subsequent period, we have to record what? Cost less accumulated depreciation, nothing but what? Book value. So as per revaluation model, on the date of a balance sheet, the carrying amount is compared with the fair value of the asset. If any change, if any increase in the value of an asset, those are transferred to. So in case of increase in the value of an asset, then that increase in value is transferred to what? Revaluation surplus and is shown under other comprehensive income in income statement. And in case of decrease in value of an asset, so is transferred to what? Statement of profit and loss. Statement of profit. This is as per IAS 16. This is as per IAS 16. But our question is due to the change in fair value. So due to the change in fair value. So here the fair value on the date of a transaction and the date of a balance sheet is altered. Due to that, these elements are created. Either revaluation surplus is created and statement of profit and loss is created. In that case, in case of as per IAS 21, as per IAS 21, we have to translate that fair value. We have to translate that fair value on the date of financial statement. So while translating fair value from foreign currency to functional currency, while translating the fair value from foreign currency to functional currency, so then some exchange gain or loss is created. Some exchange gain or loss is created if there is any change in exchange rate. That gain or loss is relating to the revaluation surplus. We have to show in other comprehensive income. If the gain or loss is relating to the decrease in value of an asset, that is transferred to statement of profit and loss. Listen carefully. So generally, as per IAS 60, property, plant and equipment is accounted in two ways, either cost model or revaluation model. In case of cost model, what happened? No fair value is considered. We always recorded at cost, or in subsequent period we recorded at what, book value. So there is no question of retranslation. But coming to the revaluation model, so every at the end of the every year or on the date of a balance sheet, we have to compare the fair value. We have to consider the fair value of the asset. Then in case of change in fair value of the asset, so it results in either increase in value of an asset or decrease in value of an asset. In case of increase in value of an asset is a transfer to revaluation surplus and is shown under other comprehensive income. Decrease in value of an asset is treated as a loss and is transferred to statement of profit and loss. Statement of profit and loss. Then, so in that case, the fair value altered, right? So in that case, verify any change in exchange rate, then on the date of balance sheet, we have to translate that fair value. We have to translate that fair value from the foreign currency to functional currency. Then while translating, any gain or loss is created, those are accounted as per what, IAS 21. But wait to show that gain or loss relating to revaluation surplus is shown under other comprehensive income. If gain or loss is relating to the decrease in value of an asset, we have to show under statement of profit and loss. Statement of profit and loss. I hope you guys clear. I hope you understood the topic. IAS 21. So effect of changes in the foreign currency, foreign exchange rates. Effect of changes in foreign exchange rate. So here in our syllabus we have only in individual financial statements, relating to the individual financial statements. Then, so here the objective of the IAS 21 is to produce rules that entity should follow in translation of foreign currency activity. So how to translate the foreign currency into the functional currency, presentation currency, and how to report that foreign currency transactions and foreign currency operations, and any exchange gain or loss is created, then how to account for. So these are covered. Exchange rates means historical, closing and average. Already we discussed, right? Next, assets. Monetary items are items that are easily converted into cash. Nothing but receivables, payables, loans, and non-monetary others. So nothing but inventory, plant and machinery, etc. So functional currency, the currency of the primary activity, economic environment in which that entity operate. So, and the currency in which financial statement presented is said to be what? Presentation currency. But while determining the functional currency, we have to consider some factors. We have to consider some factors like, so the currency mainly influence the selling price of goods, and the currency of the country whose competitive forces whose competitive forces and regulations mainly determine the selling price of goods or services, and which affect the labor, material, and other cost. So simply said, the selling prices, labor, material, other cost are denominated in which currency and settled in which currency. That is a functional currency. And here the primary factors are inconclusive, then following secondary factors. So the secondary factors are, so the currency in which funds from financing activity are generated, currency in which receipts from operating activity are retained. So initial transactions always recorded at the prevailing rate on the date of transaction. If it is not available, average rate is considered. Then settlement transaction. So if the transaction is settled during the accounting year. So first example, if you remember, first example means on 1/1/2000 X1 to 1/3/2000 X1, but the balance sheet on 31st March 2000 X1. So this is the date of transaction. This is the settlement date. This is settlement date. So this is the case. So where the translate at the date of payment or receipt using the historical code prevailing at that date, then difference if any arised, that is transferred to statement of profit and loss. Statement of profit and loss. Next, unsettled transactions if any. Sorry, unsettled transaction. The transaction still unsettled means 1/1/2000 X1 and 1/5/2000 X1. This is the date of transaction. This is the date of settlement. But here in between 31st March 2000 X1, date of financial statement is there. Then we have to consider exchange difference first in between these two dates and the later in between these two dates. The transaction still unsettled at the reporting date, then there will be an outstanding asset or liability on statement of financial position. Then if assets or liability is monetary item, it should be retranslated at the closing rate. If non-monetary items are not retranslated. Those are remains at what? Historic rate. Exchange difference will arise in the retranslation of monetary item is transferred towards statement of profit and loss. Next. Treatment of exchange differences. So if exchange differences relating to the trading activity, trading translation, nothing but operating activities, operating act, those are adjusted within operating income and operating, you have to show it in within operating income and operating expenses. If it is not trading transactions, that is nothing but what? Financing activity or investing activity. Those are shown along with the respected financing or investing activity. In case of income, it is a investing activity. It is about financing. We have to show that exchange gain or loss created due to the translation, those are shown along with that activity. Along with that, if it is an operating activity, show along with operating income or operating expenses. If it is a financing activity, show along with the financing cost. If it is investing activity, show along with interest received or income generated from the investing activity. Next, non-monetary item. In case of cost model, there is so held at cost or initially translated historical rate carry forward at this value. There is no retranslation. But coming to the revaluation mode, if the party follow the what revaluation model, then that due to the in case of revaluation, what happened at the last date of the balance on the date of the financial statement, we compare the fair value. Any increase in value of an asset transferred to revaluation surplus, decrease in value transferred to what and statement of profit and loss. So that is the question. And the second one is, in case of change in fair value, verify is there any change in exchange rate. In case of change in exchange rate, translate that fair value on the date of financial statement into the functional currency. Any exchange loss or exchange gain created, those are transferred to the other comprehensive income or statement of profit and loss. If it is relating to the increase in value of an asset, exchange gain or loss created is transferred to the other comprehensive income. If it is relating to the decrease in value of an asset, transfer it to the statement of profit and loss. Statement of profit and loss. So these are all about what? So foreign currency, IAS 21.